Hey everyone, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, I'm speaking with Kenny Zhu, who's a research analyst at GlobalX. Kenny, great to have you on the show.
Thanks for having me, Sumi.
Absolutely. So, Kenny, uranium prices surged from between 2020 to roughly early 2024, but since then they've pulled back just a little bit. Can you tell us about the uranium fundamentals as they stand today?
Sure, happy to do so. So, jumping into the market for uranium, um, as it stands right now, the uranium market is in a deficit, and we think these markets are likely to continue to see a little bit of upward pressure, at least over the medium term, due to three key factors. From our perspective, supply chain is one of them, geopolitics is another, and then the energy infrastructure and capacity story is essentially the third factor that I would highlight in terms of what's driving uranium prices. But in combination, I think this confluence of these three factors are likely to contribute to, if not exacerbate, the structural shortage of uranium supply that we're seeing and highlights the bull case for uranium investment.
Kenny, uranium is, of course, closely tied to nuclear energy. And for a long time, nuclear energy seems to have fallen out of favor. But more recently, it seems like it's making a comeback. Can you talk about that bull story for nuclear energy?
Absolutely. So just to take a step back, I think it's important to understand contextually where are we coming from. The last true bull cycle where uranium prices hit around $100 was in 2007, and that was primarily driven by growth in Chinese consumption at the time. In the period following that, the world entered the global financial crisis, which saw uranium prices take a hit. Even in the recovery phase after that, in 2011, the Fukushima reactor disaster happened, and that further pushed uranium prices back down. And along with the proliferation of cheap alternative fuels like natural gas and oil from the US shale revolution of the time, that kept uranium prices trading at a muted level in much of the 2010s. Those prices actually fell as low as $18 per pound in 2017. Fast forward to today, and uranium prices are already back near $80 per share. Now, to your point, the prices actually hit $100 a share again in January. But right now, they've fallen a little bit back to $80 per share. In our view, the underinvestment from the previous cycle is largely responsible for today's higher uranium prices, especially as the market has been pushed back into a deficit. But we think there's a number of key factors to keep in mind for the long run. Even with a little bit of recent weakness, you still have pressures coming in from the ramp up in AI. That wasn't a factor that was even foreseen just 1 year ago. On top of that, nuclear utilities, based on some of the estimates that we've seen, are expected to continue their resupply cycle through the current market despite the elevated prices. And the fact that they got flat-footed by that lack of recent production will likely continue to put upward pressure on prices. Finally, the last item I would highlight there is the entrance of spot uranium trusts into this market over the past few years. That's added another source of demand through buyers in this market.
And Kenny, what's the relationship between uranium and nuclear? Is it assumed that if we get more nuclear plants being built, that demand for uranium is going to go up? And how does supply factor into it? Is there a shortage of uranium supply?
Sure. So I'll tackle that question in a couple of bits. From the demand side, right? The primary consumer of uranium historically has been nuclear power. There's been some talk of nuclear weapons programs, but that has not been the key driver of buying, at least within the past few decades. So for the time being, utility usage continues to remain the overwhelming source of buying for the nuclear energy story. In terms of the infrastructure, right now, China actually is building 25 new nuclear reactors, and they have the greatest number of nuclear reactors under construction. On top of that, if you look at other areas of the emerging markets, India is actually growing 7 new nuclear reactors as we speak, and there's about 10 more being constructed in the emerging markets. At the same time, going back to the utility story, within developed markets, you're seeing places like the United States and France bring back online mothballed reactors that have been offline for the recent past, right? Some projects that I'll highlight there include the Vogtle reactors down in Georgia, which is one of the largest nuclear reactors within the United States. That's entered back into service over the past year. And just today, this morning, Microsoft actually penned a deal with Constellation Energy to bring 3 Mile Island out in Pennsylvania back online as well. So we think there's a huge story to be told there from the consumption perspective, at least not even just from the United States, but also in terms of the global growth story as well. From the other side of the factor, right now, in terms of the supply picture, again, that 2011 period was really when we saw nuclear and uranium demand take a hit. And the result of those low prices in that period, in the period following Fukushima, was a sea change against uranium. And that resulted in uranium miners taking a step back. Some of the biggest producers in the field, including Cameco and Kazatomprom, cut down on production substantially in reaction to lower prices. Well, right now, those prices have shifted because the average nuclear supply cycle takes about 10, maybe 15 years. We are about 10 years after Fukushima now, a little more than that, actually. And right now, nuclear utilities have to resupply. So the confluence of that deficit in supply that we're seeing in the production markets, corresponding with the utility resupply cycle, that really highlights the bullish argument for uranium in this market.
So everything you're describing, Kenny, certainly sounds bullish, but is there a bear case for nuclear, perhaps competition from other forms of clean energy like solar? Does that play? Is there any risk of, the story not playing out the way you're suggesting it will?
Yeah, there certainly is a risk, right? Because with uranium, it's a commodity, but there's also a growth story underlying it. So if you were to ask me, is it more subject to the cyclical flows of the market, or is it subject to the long-term structural flows? I would say it's a little bit of both, right? On the uranium mining side, those are typically leveraged type investments in the sense that they have high fixed costs, and their direct exposure to the commodity allows their growth to outpace the market during bull cycles. However, during market volatility, as we observed in July, they typically will also lead the market down in any corresponding sell-offs. Now, something to highlight would be the industrials in this universe, which include names like Mitsubishi Heavy Industries, and names like that are involved in the direct manufacturing of nuclear plant materials, right? And specifically, I mean the equipment and the infrastructure required to build those nuclear plants. There's a strong structural growth story behind them. So again, if you tie it back to the bear case, right, you might lean into the cyclical nature of this universe. But right now, we think, again, the structural supply shortage story that we're seeing highlights the bull case here and puts a little more upside tilt to that argument in our view. The final things that I'll address there was what you had said regarding the competition from renewables and even fossil fuels, right? Looking at those as the alternatives, right? If you consider where nuclear stands relative to those alternatives, renewables actually is a very cheap manner of energy production, but it faces its own intermittency issues. And until we see the battery technology improve on that front, we think, yes, investment will continue in that sector, but it will likely not compete with the cost efficiency of a completed nuclear plant. On the other side of things, if you look at fossil fuels, natural gas is expected to contribute something like 60% to the additional data center processing capacity in the AI narrative. And the other thing is, while natural gas is cleaner than coal, and it contributes nearly 1/3 to 1/2 of the emissions there, it's still not ideal for the environment. Nuclear really takes the cake there in the sense that it emits carbon emissions on levels comparable with wind and solar. And we think this combination of broad scale reliability, clean and reliable 24/7 baseload support, that really highlights the argument for nuclear in that broad comparison.
Final question, Kenny. What's the best way for investors to capitalize on this secular bull story for uranium and nuclear that you're talking about? You talked about, uranium miners, you talked about uranium funds that hold uranium directly. What's the best way to do it?
Yeah, in our perspective, right, there's a few ways to gain exposure to uranium or nuclear technology at large. From our perspective, we think that the diversified ETF represents one of the easiest and most efficient ways for investors to access this market. And specifically, I would highlight the URA Global X uranium miners ETF. And this ETF essentially tracks the performance of companies that are expected or have exposure or business operations within the uranium industry. It's one of the oldest funds within the segment. It's been around since 2010 and it has a 14-year track record. But essentially, what I'd like to highlight about this fund is its diversified exposure to the universe. Not only will you get exposure to nearly 50 holdings, those holdings are split across different universes. And that not only includes uranium miners and explorers, which are the ones that tend to run up on the market bull cycles, but it also includes the component manufacturers and the industrials that I spoke to there. So names like Mitsubishi Heavy Industries, right? Those companies that are really involved in the construction of those SMRs in terms of getting nuclear equipment to the front, right? Those are what are also held within this universe. The final interesting universe that I'll highlight there are the uranium trusts. This is a little bit of an interesting character in terms of the buyers of uranium out there. Essentially, these trusts go out there, they buy physical uranium, and they hold on to it. And what they offer is that they give you a little bit of a better direct or more direct exposure to spot prices in uranium markets. So we think the diversified approach makes a lot of sense. And we think that a diversified ETF like URA, which offers those types of funds, has a lot to offer in terms of the advantage there.
Fantastic. Well, we'll leave it there, Kenny. Tons of great information. Thanks so much for your time.
Pleasure talking to you. Thank you.